Today we're going to start talking about the aging of receivables. This is going to help us with the second way to calculate our allowance for doubtful accounts. The longer an account receivable is outstanding, the less likely it is that it will be collected. We base our estimate of uncollectible accounts on how long amounts have been outstanding. That's called aging of receivables. So longer they've gone without paying, the less likely they are to pay. So here's an example of a chart of a company recording the receivables to show the aging of receivables. You can see at the top there are customer names, the balance of their accounts, and then how past due they are. First, this column is anybody who's not past due. So Brock Company is not past due. Then 1 to 30 days, no company is 1 to 30 days past due. 31 to 60, Ashby and Company is 31 to 60 days late. 61 to 90, nobody. 91 to 180, BT Bar is 91 to 180 days late. Then we have 181 to 365, and BT Bar also has an amount that is 181 to 365 days late. If we look down at the bottom, we go ahead and see the percent uncollectible. So if they're not past due at all, we assume only 2% of those are going to become uncollectible. As we get to further past due, you'll see the percents, and they're going up. So if over 365 days, 80% uncollectible, 181 to 365, 50, and so forth. So the longer past due they are, the higher percent of becoming uncollectible. So to go ahead and take those amounts, we have the total, here's our total balance, total not past due, total of the 1 to 30, and you'll see these lines here mean that we've got some missing. So we've totaled those up, and then we multiply them by the percent that is going to be uncollectible to get our estimate of uncollectible accounts. So of not past due, 2% of those are estimated uncollectible, that's $2,500, etc. So the percent of sales method we looked at already. That's based on the balance in the allowance account, and that's going to help us determine the adjusting entry. X-Tone has an unadjusted credit balance of $3,250 in the allowance for doubtful accounts. In Exhibit 1, we looked at previously, the estimated uncollectible accounts totaled $26,490. Looking at that, we're going to go ahead and look at this percent of sales method. So we take the balance of $26,490 and subtract the $3,250. So our adjustment is $23,240 that needs to be added to the account. These numbers are coming from this slide here. We had a credit balance of $3,250. We estimate that $26,490 are going to be uncollectible. So $26,490 minus the balance, we only have to adjust or add in $23,240. So what are we debiting? We're going to go ahead and debit the bad debt expense. We're going to credit allowance for doubtful accounts. That way we have that expense sitting in our bad debt expense, and we have our bucket of allowance for our allowance for doubtful accounts filled up. So here is an example of another view here. We have our bad debt expense. Our adjusting entry gives us our balance. Our allowance for our allowance for doubtful accounts, we had a balance of $3,250. We had an adjusting entry of $23,240. So our adjusted balance, then, we have to add those two together to get $26,490. If the unadjusted balance of the allowance had been a debit balance of $2,100, the amount of the adjustment would be $28,590. So bad debt expense is not affected here. It's the same thing, the adjusting entry amount and the adjusting balance. Our adjusting entry would be $28,590 because we still want to get to the $26,490. So $28,590 minus the $2,100 gives us $26,490. Here's a problem. At the end of the current year, we have accounts receivable with a balance of $800,000, our allowance for doubtful accounts with a credit balance of $7,500, and net sales for the year totaling $3,500,000. Using this method, the balance for allowance for doubtful accounts is estimated at $30,000. So please go ahead and determine the adjusting entry, the adjusted balances, and the net realizable value. For A, the amount of the adjustment is the $30,000 minus the $7,500. Where did these come from? The $30,000, excuse me, $30,000 came from the estimated adjustment. The $7,500 was minus that credit balance, so we only have to adjust for $22,500 for the adjusting entry. Part B, our accounts receivable are not affected by the adjustment, so their balance is still $800,000. The allowance for doubtful accounts is going to be $30,000 because that's the amount that we are estimating is going to be collected. That's the amount we have to get to. Our bad debt expense is going to be $22,500, the amount that we actually record as our adjusting entry. Net realizable value is going to be $770,000. We have $800,000 accounts receivable we expect to not be collected, minus the $30,000 allowance, the $800,000 that we expect to be collected, minus the $30,000 in the allowance, gives us $770,000 for our realizable value. Depending on what estimation method you use, you're going to get different amounts. If you take a look at the percent of sales method, you've got a bad debt expense estimate of $22,500, which comes to that $22,500 plus the $3,250 for your allowance. So the bad debt estimate is going to be added to whatever is in your allowance to give you that new estimate. If you're looking at analysis of receivables method, you're going to have your allowance is going to be the $26,490, which comes from that estimate amount and the difference between the two. So bad debt expense and allowance for doubtful accounts, you're going to get two different numbers in your allowance account. One, you account for what the balance was. The other, you do not. The fifth goal is to compare the direct write-off method and the allowance method of accounting for uncollectible accounts. So if we take a look at the journal entries for the two methods, you'll notice the only difference is in the direct write-off method, we go to the bad debt expense directly. For the allowance method, we go to the allowance for doubtful accounts. Now all of this is the same, so what really makes it different? If we look at the next slide, we'll see that we have our write-offs of our accounts here directly to the bad debt expense when they're not going to be collected, but for the direct write-off method is bad debt expense. But we have to get it to bad debt expense in the allowance method. So we have an adjustment. In the direct write-off method, there's no entry because there's no adjustment because it's already there. In the allowance method, we have to go ahead and take whatever the balance in our allowance for uncollectible accounts is and adjust that according to our method of determining the allowance and write that to bad debt expense at the end of the month or at the end of the year. So in comparing the two methods, you'll see that the bad debt expense is recorded when the specific customer accounts are uncollectible under the direct write-off method. You'll notice the allowance account is not used in the direct write-off method. The companies that use direct write-off, typically small companies with few receivables. It's not going to be a big expense. They don't have to prepare for that. The allowance method is based on either percent of sales or an analysis of receivables, one of those two methods. The allowance account is used, and larger companies with more receivables tend to use the allowance method. Our sixth goal is to describe the accounting for notes receivable. A note receivable is also called a promissory note, and it's a promise to pay. The maker is whoever is making the promise to pay. So I make the note, I'm promising to pay. The payee is who the note is payable to, who's going to get the money. The face amount is the amount that's written on the note for its face value, what it's worth at the time. Issuance date is when we issue the note, when the note is written and the promise begins. The due date, also known as the maturity date, is the date the note is to be paid. So if it's a 30-day note, 30 days from when it is written is the maturity date when it matures and becomes due. The term is the amount of time the note is written for. The interest rate is the rate of interest that has to be paid above and beyond what was borrowed. Here's an example of a promissory note. The parts are all labeled, so the maker is the person who is making the promise. The face amount is the amount that they are promising to pay. The payee is who is receiving the money. The issuance date is the date that the promise was made. The due date is also called the maturity date, when it has to be paid. The term is the length, in this case is 90 days. And the interest rate, you'll see, is here, 10%. So they will pay the $2,000 plus 10%. Why is the due date of a 90-day note dated March 16th? Calculating these notes takes time and focus. If you try to rush through, you won't get it correct. So we have a 90-day note dated March 16th. So we start March 16th. There are 31 days in March, and I will show you a trick how to do that in a moment. Minus the issuance date of the note, 16 days in March are already gone. So we have 15 days left in March. So that's 15 of the 90 days, which leaves us with 45 days left. April has 30 days, so we're going to go through all of April. Now we are also going to go through the days in May, 31. We're going to add the day in June with a due date of June 14th, and we get 90 days. We also have another approach. You might do it as total days in the note are 90 days. Number of days in March are 31. The issuance date is the 16th, so you subtract that and get 15 days. This is going to be a step-by-step method. That leaves us with 75 days. Number of days in April are 30, so that leaves us with 45 days. May has 31 days, so that leaves us with 14 days, which means that June 14th is our due date. I find this approach the easiest. You can do whichever works for you. Here's a visual example of that. March, we start on the 16th. The 16th through the 31st is 15 days. Then we have 30 days in April, 31 in May, and 14 in June. If you choose to do a number line like this, if that works for you, that's fine as well. So going ahead and doing the entry for this, we can say we received a $6,000 12% 30-day note dated November 21st in settlement of account of W.A. Bunn Company. So in this case, somebody had accounts receivable, couldn't pay, but they promised to pay us within 30 days, extending that. So the amount is $6,000 because we received a $6,000 note. What we're going to debit is notes receivable. It's an asset, just like accounts receivable. Notes receivable goes up because now it's a note. And we're going to credit their accounts receivable. So we're changing it from an accounts receivable to a notes receivable. We're giving them an extension, a very short extension. On December 21st, when the note matures, they calculated the maturity date for us. The firm receives $6,060. That's the $6,000 plus $60 in interest if you did the calculation. So the notes receivable, we're going to get rid of the $6,000 note. We're also going to receive $60 in interest revenue. And we're going to receive that all in cash. If W.A. Bunn Company fails to pay the note on the due date, it's considered a dishonored note receivable. So if it's not paid, it's dishonored. The note and interest are then transferred back to the customer's accounts receivable. So we debit accounts receivable the full amount, because now they owe us the note plus that interest they didn't pay either. We get rid of the notes receivable because now it's moved back to an accounts receivable. And we get rid of the we calculate the interest revenue. We say that we've received that, and now it's just been transferred into an accounts receivable. So here we go, another one, a 90-day 12% note dated December 1st, 2010 is received from Crawford Company to settle the account, which has a balance of $4,000. So it's going to be a $4,000 note. You're going to debit notes receivable to make it a note. And what are we changing it from? You have to credit the accounts receivable, taking it out of accounts receivable, putting it into notes receivable. Assuming that the accounting period ends on December 31st, we have to adjust it for the interest that we've done for that period. So we take our $4,000 times 12%, and we take it 30 over 360. 30 over 360 to ease calculations. Yes, there are 365 days in a year. We're accounting for 30 of those days. We use 360 to simplify calculations. So when we calculate that, we get $40. We make that interest receivable, and it's interest revenue. It's interest receivable because we haven't received it yet. It's accrued interest. See the next video for continuation.